In this lesson, I'll explain what the covered call strategy is and show you some examples to provide you with the basis on which you might choose to learn more about the strategy or to start implementing into your investment portfolio. So what is the covered call strategy? The covered call, which is also referred to as the buy right strategy, is an income approach to investing. Using a stock position as the basis of the strategy, call options are sold for the purpose of receiving premium. It's the selling of the call option that is how the stock position becomes an income approach. While there are many variations in how the strategy can be managed, the premise is that the investors will set a position on a regular basis to produce a premium return from selling calls. So how is this done? Well, firstly, we're choosing a stock position that we believe has the potential to remain steady or rise slightly within the given time frame. Now, after purchasing the shares, we then sell a call option. Now, that is chosen around certain criteria to ensure we receive sufficient premium income and so that it suits the time frame for our view of the underlying stock. So, for example, if we purchase this stock at, say, $36, our time frame expectation for the strategy might be 1 month from now. We choose to sell the $38 call option, which at the moment is offering $1 in premium. Now, at the end of the contract, if the share price is above $38, the position will be assigned and we sell our shares at $38. Now, for this example, that would equate to a total of a $3 gain, or approximately 8.3%. Now, if the share price remains below the $38 strike price, the sold call option will expire worthless. Now, what this means is that we keep our shares and we have kept the premium that we received for selling the call option. We now have the choice of selling call options again, or selling the stock if we no longer want to continue with that position. Our goal is to repeat this process on a regular basis. Most traders adopt a month-to-month approach, cycling around the monthly options expiration calendar, whilst other traders might operate on a quarterly basis or any time in between. For portfolio management, the investor needs to consider position allocations. They also need to think of the frequency in which they change their stock or the underlying shares, the cycle of the options as we've mentioned, the broader market conditions, and individual company announcements. Not too dissimilar to normal stock investing. As an income approach, the strategy outperforms other income strategies such as bond investing or investing in stocks that provide a dividend return. But like dividend portfolios, the capital value of the underlying positions are subject to potential declines in share prices. Now, this is the greatest risk to the investor who adopts either a dividend approach or the covered call approach. But that is the same for stock investors across the board. Now, compared with investing in stocks, the strategy won't outperform in a strong bullish equity market. But capital gains are not the purpose of the strategy. Consistent income is. The strategy will, however, outperform during sideways or range-bound markets and provides reduced risk during a bearish or downwards market environment. The purpose of the strategy is to provide a regular and consistent return, reducing some of the uncertainty that comes with stock investing. The covered call or buy right strategy is suitable for investors wanting to maintain exposure to stocks, but who are looking for potentially higher returns than bonds or dividend investing. The strategy can be managed to provide a regular cash flow or income if you like, or it can be dynamically managed for timing peaks and troughs in the market. If you'd like to know a little bit more about the covered call strategy, you can visit MatthewBrownMentoring.com or click on the button below for a free course on the covered call approach just to get you started. Or visit my Facebook page for regular updates on market strategy and trader mindset discussions.